All right, let's talk about taxes for a minute. We do a lot of difficult things in our work, and I thank you for that. But you still have to understand a few financial things in your life, one of which is how taxes work, particularly how the tax brackets work. And it's pretty amazing, actually, when you talk to typical Americans, including physicians, how few of them actually understand our tax code. And we are talking about federal income taxes. We're not talking so much about state income taxes. We're not talking about payroll taxes like Social Security and Medicare. We're not talking about property taxes or gas taxes or sales taxes. We are talking about federal income taxes. And there are some things you should understand about federal income taxes. One of the first is that it's a very progressive tax system. Now, depending on where you fall on the political spectrum, you may feel like it's not progressive enough, or you may feel like it's overly progressive. But the fact is, the way it works right now is a little bit over 40% of people either pay nothing in federal income tax or actually get money back in federal income tax. And I'm not talking about a tax refund. I'm talking about actually having negative taxes due to tax credits. The top 10% of earners pay about 70% of taxes, and the top 1% of earners pays 39% of taxes. So it's a fairly progressive system, and you should understand that. As you make more, not only will you pay more money, but you will pay a higher percentage of your money. And that is often described as tax brackets. What a tax bracket is it really just helps you kind of comprehend your marginal tax rate. It's really important that you understand the difference between marginal tax rates and effective tax rates. Okay, a marginal tax rate is the rate at which you pay taxes on the next dollar you earn. So if you earn another $100 and $43 goes to the tax man, your marginal tax rate is 43%. The other tax rate is called your effective tax rate. And the way you get this is you take all the dollars you pay in tax and you divide it by the dollars you made. Your effective tax rate, due to the progressive nature of the tax code, is always less than your marginal tax rate. And so, your marginal tax rate might be 43%, and you may find your effective tax rate is only 19%. And that's just because as you go along, you fill the brackets. And that's really, really important to understand. For example, if you look at the 2021 brackets for unmarried people, okay, these are for single people, you will see that the first almost $10,000 is taxed at 10%. You will then see the next $30,000 or so is taxed at 12%. The next $46,000 is taxed at 22%. Then the next, what does that work out to be? $78,000 is taxed at 24%. And the next $50,000 is taxed at 32%. And then the next $300,000 is taxed at 35%, and everything beyond there is taxed at 37%. Now, those brackets are a little bit bigger if you're married filing jointly, and actually vary a little bit if you file as a head of household, which usually means a parent and a child. The standard deductions also go up with your status. In 2021, it's $12,550 if you are single, it's $25,100 if you are married filing jointly, and it's $18,800 if you are filing as head of household. And so what that means, whether you itemize your tax deductions, basically we're just talking about the ones that go on Schedule A, which is basically your mortgage interest, $10,000 of your state or property taxes, and your charitable deductions are basically the main things that go on Schedule A. You either take the sum of all those or you take the standard deductions. Standard deduction, which is $25,100 if you're married for 2021. And that essentially functions as a 0% tax bracket. Once you get down to your taxable income, then all of that is taxed. But there's essentially money above and beyond that, which is not taxed at all. And that's covered by the standard deduction or your itemized deductions. And so keep that in mind, that it is entirely possible to have a taxable income of 0 if your income is low enough. All right, so the way those tax brackets work, as you go along, you fill them up, right? Just because you get bumped into the next tax bracket doesn't mean that all the money you make is taxed at 35% or 37% or whatever the next tax bracket is. Only the money you earn in that tax bracket is taxed at that rate. And that's really important to understand. All right, another thing that's important to understand is that there is a difference between taxes withheld from your paycheck and taxes that you actually pay. Very different numbers, right? The government has regulations on how much an employer must withhold from your taxes, and there are penalties if you do not pay enough tax at the end of the year. Basically, if you have not paid enough tax throughout the year, you get penalized for that. You might have to pay penalties, you might have to pay interest if you don't have enough withheld from your paychecks or that you send in voluntarily as quarterly estimated tax payments. If you don't have enough withheld, you may owe some penalties and interest when it comes time to do your tax return. That it is a pay-as-you-go system. My state taxes are not like that. In Utah, you don't have to pay the government anything until tax day, until April 15th of the next year. You don't have to send them anything. And there's no penalties whatsoever. And so if you're self-employed, you can just write one big check in April. No big deal. Obviously, if you're an employee, they're going to withhold some from you as you go along. But it's not a pay-as-you-go system. The federal income tax is pay-as-you-go. You're expected to pay as you earn the money. And so how they enforce that is by giving you penalties and interest if you don't pay enough as you go along. So how much is enough? Well, you have to be in the safe harbor. That means you either pay 100% of what you owe for that year within $1,000. You can be $1,000 off and still be okay. Or you can pay, for a high earner, 110% of what you owed last year. So if your income's rising rapidly, you can be in the safe harbor, even though you weren't anywhere near right in how much you paid as you went along through the year. Those numbers are a little bit lower for lower earners. It's 90% and 100% instead of 100% and 110%, but it's basically the same game, being in that safe harbor to avoid taxes and penalties. If you have any more than that withheld, if you have any more than that paid in estimated quarterly tax payments, you don't get any benefit for that. They don't pay you interest on it. Okay? Basically, you just gave the government a free loan, and that is what a tax return is. It's just the government giving you back the money that you loaned to them without any interest for up to 16 months. That's what a tax refund is. It can be even longer if you got a tax extension. But you just need to understand that there's a difference between what is actually paid, what you actually owe in taxes, and what is withheld from your paycheck if you were a W-2 employee. You can vary the amount that's withheld from your paycheck by messing with your W-4. You can have more withheld, you can have less withheld. A couple of years ago, as part of the Tax Cuts and Jobs Act, they actually changed the numbers of how much was supposed to be withheld. And so people started getting smaller tax refunds because the government wasn't required to take as much money, or the employer wasn't required to take as much money out of their paychecks. And they were upset about it. They're mad about it because they're like, oh, I get a smaller refund. Well, you got to keep the money in the first place. It's just silly to be upset about that, right? So it's really important you understand that difference. Okay, another factor that confuses a lot of people is that they don't understand what federal income tax is. They're assuming all this stuff taken out of their paycheck is all federal income tax, right? You have Social Security withheld, you have Medicare withheld, right? You might have some other stuff withheld. Those are not federal income taxes. Just because you're paying other taxes doesn't mean you paid them in federal income taxes. If you actually run the numbers, you will see that someone who has $100,000 in income will pay about 8.6% of that in federal income taxes. But their actual tax burden will be significantly higher than that. At that level of earnings, and particularly at levels of earnings under $100,000 a year, most of your taxes are actually payroll taxes, Social Security and Medicare taxes. And so be prepared for that. All right. And then lastly, some people just get confused. If it's taken out of the paycheck, they think it's tax, right? Even if it's paying for their health insurance or it's paying for their, it's a 401k contribution or something, right? Just because it's taken out of your paycheck doesn't mean it's a tax. You have control over those things. If you don't want to pay for health insurance, I suppose you can do that. I don't recommend it, but you can do that. Even court-ordered child support might be taken out of your paychecks. But again, that does not qualify as a tax. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.